So this is the
Right.
second week in a row that we're closing at all-time highs. It's pretty sweet. We had FOMC, which kind of turned out how we were expecting. It was actually the SEP was a bit more dovish than I was expecting. Like they're forecasting increasing GDP, increasing inflation, decreasing unemployment. So it was a very dovish SEP, but then Powell came out pretty hawkish at the presser, uh, and that kind of brought the market down a little bit initially. But then we completely rebounded today. So, what are your thoughts on how it all played out?
Well, I think the way the market was positioned going into FOMC was obviously, I mean, we had like something of the sorts of 9 up days in a row in the Nasdaq into FOMC. So I'd say the market was pretty much expecting some sort of dovish outcome, and the Fed did deliver the 25 basis point cut, and then I think what took stage is the fact that the SEP kind of alludes to the point that the Fed is somewhat no longer prioritizing inflation and very focused on labor. As you just said, they growth is up, growth forecasts go up, inflation forecasts go up at some points over the next 3 years in the SEP, and rates go down. And that is a secondary effect from the labor data we've been seeing the last couple of months, right? Because we have to understand that the market was priced for that. The market was positioned for those lower rate expectations in the SEP, which is the summary of economic projections from the Fed, right? If you look at it on a simple basis, right, just look at the 2 year yield. The 2 year yield was down into FOMC and it didn't move much. And this is what this is telling you is the market over the last couple of months priced in that dovish SEP rate path, because you have to remember that the SEP comes out every quarter basically, right? So the last SEP meeting was in June. So when you look at the SEP and you see this big drop in rate expectations, right, over the next couple of years. The last time the estimates came out, the market, the 2 year was sitting around 4%. The market was somewhat priced for, still dovishness, but nowhere near what we're seeing right now. And what ended up happening was labor took a hit the last couple of months, at least on the headline figures, and the market got really dovish. And what you saw happen yesterday was the Fed almost deliver on those expectations. But I do think that the Fed was a bit too dovish in the fact that they're delivering on those expectations, but they're seeing all the other aspects that would require them to be more hawkish go in the other direction, right? Like resilient growth, um, and above target and whatever you want to call it, trend inflation, are things that should kind of get the Fed thinking, okay, maybe we're close to neutral. And they're basically showing you on their policy path based on the SEP that they think their neutral rate's 3%. So they're telling you that they're still restrictive and they're going to cut. Their eye is the 3% barrier on Fed policy. That's their eye of being neutral, right?
Yeah.
So as long as they're above 3%, the Fed is considering themselves restrictive. So what matters more is the curve and how the Fed gets there, right? Because at the end of the day, the market's already priced in all the Fed rate cuts, right? When they say everything's priced in, that little joke, which is true, the market prices in the entire cycle. So the market has the Fed going down to about 3% already. The problem is when you get there, the Fed increased the speed basically at which they will cut the front of, add rate cuts to the front of the curve and decelerate faster towards 3% or fall faster towards 3%. And that's in light of a seemingly resilient economy. So the market looks at that and says, okay, the Fed's cutting rates, but they're not cutting rates because the economy overall is slowing. They're cutting rates because one data point in the economy, which labor tends to be an important one, is showing signs of turbulence. But all the other data points are fine. Inflation's above target, which is a signal of in a way, it's a signal of robust demand, right? Because if demand goes to zero, there is no inflation. And then growth also above their estimates. And these are signs that tell the market, look, the Fed's cutting because of unemployment, but everything else is fine. So Fed's loosening policy here and accelerating the speed at which they're doing that due to one specific print that likely or has a great risk of reversing. So you get this thing, you get the situation of policy of the market anticipating a policy mistake, which is
Yeah.
why the market's ripping the way it's doing.
Yeah, it's kind of like playing out as our melt up theory in that ledger post that we wrote. That seems like is the way that we're going. Like the Fed pretty much came out and admitted that they're going to cut at labor softening. Anything that signals labor softening, they're going to cut. And if that reverses, now all of a sudden they're too loose for current economic conditions. And that's what fuels the
Yeah.
melt up.
And I'd like to talk about, like, just on a simple term, if you look at inflation swaps, which we just added the inflation swap series to the macro base. So if you use the macro base, which is free, you can go to our website, log in quickly, and you can see this chart real time. Now, what you'll notice about the inflation swaps are that last summer, when we had this major labor scare, Sam rule triggered, everyone was on their heels, right? Swaps printed all the way down, 10-year swaps, all the way down to 2.24. And I keep bringing this chart up because it's important, right? Even though we've had this labor slowdown over the last couple of months, swaps are still at 2.57. So they're nearly half a, whatever you want to call it, 30, 40 basis points above the lows here, right? So my thinking is, look, okay, there's obviously some persistence in inflation expectations. And you might say, oh, tariffs. Yeah, tariffs play a role, but in theory, tariffs should be a one-off. So on a scale over 10 years, tariffs should have a short-term inflationary impact, but they shouldn't be dragging swaps up like this high, right? Because if you look at on 5 years, right, you'll notice 5 years are higher, and you'll notice that 2 years are substantially higher. And that's because over the next 2 years, the average inflation over the next 2 years is going to be skewed by tariffs, understandably. But what you'll notice again is that over the cycle of the next 10 years, the market's not seeing enough weakness in expectations to really bring swaps off their highs. So, what's this telling me? Well, it's telling me, look, the market is still thinking that there is an inflation issue rather so much than a recession issue. And another simple way to look at this is just look at crude oil, right? Let's look at crude or commodities, even better, commodities basket, GSG, right? Look what happened last. We'll take DDAP off to make this easy on the eyes here. Look what happened last summer. GSG hit $19 or $20. That was in that labor market fear, slowdown fear, recession fear, right? Because when labor implodes, it's deflationary typically because you lose all demand, right? So therefore, again, no demand, no supply, yeah, no demand, excess supply, and lower prices, deflationary, right? So what's happening now is commodities are actually up at their upper end. Like this is not a complete 180 from what we saw last year. And the Fed is continuing, or at least signaling, reaffirming with their forward guidance in their SEP that they're going to continue to ease into this. And that's something that I think is fuel for a melt up. Now, I'm not saying we're currently in a melt up. I don't think a melt up could likely be in the making, but I don't think we're deep into one. I can tell you that where commodities are kind of gives me the inclination that, look, swaps, commodities, everything's on their upper end. Therefore, there's a good chance that the economy's not as weak as it was last summer. You're seeing that with GDP now as well. And therefore, likely reacceleration risks are a main concern at the moment in the economy. And we saw some good well, I think it was ISM. What are the ISM numbers this morning? What was that? Is it ISM that came out?
I think. Let me take a look. Philly Fed.
Philly Fed, sorry.
Yeah.
Yeah, it was Philly Fed this morning that showed major reacceleration in September. And that's just something, again, like this is 1 month, right? What does the next 6 months look like?
But like
And
this isn't new news. Like why did the 10-year yield drop going into FOMC.
Well, I think what ended up happening was um, the market, like we said earlier, the market rallied 9 days in a row. At, bonds rallied as well. I mean, you basically had everyone under the impression that, look, like the Fed is going to cut and the SEP likely is going to show a deteriorating economy, right? Everyone's thinking like I don't think anyone had growth estimates ripping every year, or basically being revised up every year when the whole fear around labor market basically causing the economy to slow, right? Like it's a contradictory, right? Like you think, oh, the Fed barely revised up unemployment as well. I don't know if you saw that, right?
Yeah.
Like it wasn't like they ripped the median up on unemployment. So it kind of makes you think like the market was really positioned one side, and what ended up happening was the completely like the outcome that I don't think everyone or anyone really expected, was where like the SEP was dovish, but it was really supposed to be more hawkish, but it was overly dovish. And it wasn't dovish because of a recession. So when you have dovish policy, so this is something we have to break down into two fundamental buckets when you talk about bonds, because I know you're talking about bonds rallying. When you have dovish policy that's backed by a weakening economy, you have the Fed on a reactive basis, right? The Fed is reactively cutting to a negative economy that's creating negative reactions, right? Um, Now, if you have a proactive Fed that is trying to ease, or as they call it, risk management cuts, they're trying to ease ahead of any real systemic weakness. And one of the mandates that the Fed is supposed to be claiming that they have under control is not under control, being inflation. That creates a different scenario. So the reactive cuts are, I think, what the market was expecting. The market was expecting the Fed to be reactive in their estimates to say, okay, like unemployment broke or labor broke, so growth is going to break. They would have just flushed it, right? And that would have, I think, been in line with what the market was seeing, or even more dovish, and rates would have gone even lower. But the Fed came in and did the complete opposite. They basically came out and said that they're doing, again, risk management cut, and they made the whole thing. They cut 25 bips, but they made the whole thing look very proactive, but they still guided towards further easing. So in that scenario, right, the market's like, okay, the Fed's easing, but like they're not easing because it's things are hitting the fan. They're easing because they're afraid things are about to hit the fan. So you kind of throw the odds back over to the reacceleration camp now, because if the Fed's not proactive, that means nothing's actually broken yet. And therefore, if nothing's actually broken yet, if status quo continues, the Fed is going to be easier in an environment that reaccelerates. Therefore, bond yields need to reprice higher. And that's what happened yesterday at FOMC. And a little bit of offsides action. Again, everyone was kind of very tilted to the dovish side. First rate cut in what, 9 months or something like that, right?
Yeah.
Or even a
Yeah.
little
I
bit
mean,
longer.
like
So
the Fed funds futures have been expecting rate cuts for a while now, and then whenever they don't happen, they just get pushed out on the curve. So now we're
right.
actually finally starting to see it happen. But I don't know if I really believe that they're going to cut two more times this year. I just don't see why they would. And the way Powell came out talking about labor and how they understand that the labor dynamics are different now, like hiring and firing are both slowing at the same time. He's like, the Fed is aware that any softening in the labor market doesn't necessarily mean softening in GDP growth.
Yeah,
So I
that's an
just,
interesting dynamic. Yeah.
yeah, I feel like they're aware of it, and they're aware that they don't need to cut every single meeting.
Well, I think that so I keep mentioning this, but I put up this post and I really think that this is true. I really think that the board, the reason that you would have given that guidance today, the other day, right? You would have given that forward guidance, even if you wanted to cut, because at the end of the day, look, even based on our neutral estimates, the Fed is currently at 4.25% or 4%. The Fed is restrictive, right, at 4%. So if the Fed wants to get to neutral, they have to bring policy down, regardless of how you look at it. And the market does it for them through forward guidance, right? Because very few people are actually operating on the benchmark rate unless you're a bank, right? Like all loans, anything that has any type of duration is going to be based typically off the treasury curve, right? You're talking about auto loans, mortgages, etc. Your mortgages are not pinned to the Fed funds rate. So these rates bake in future expectations already. So in some way, the forward guidance does actually work real time, which is why we like to say, like, when the Fed actually cuts, nothing really changes except like short-term lending, things like HELOCs, maybe some credit cards, savings accounts, and margin loans, things like that get affected by the front end really by a large margin. And this is where, like, I think the Fed went so easy into forward guidance, and they became so accommodative to the point where, like, the market is moving up, right? Given that, look, okay, the Fed's going to bring their policy down to neutral, but I think they're running the risk of overshooting that policy reduction. And the prime driver for this, again, is what I've been saying, is the Fed is very tuned to deflationary shocks. To them, labor. The Fed thinks this is how the Fed thinks of things. They believe that if they break labor, they'll break inflation, which is why they're doing what they're doing. You're seeing the Fed you'll notice that their inflation estimates don't really go up too much, but their growth estimates do. And the reason their inflation estimates don't go up too much is they believe that if they ease policy enough and they stem the losses in labor, they'll neutralize the economy. That's what's going on. If the Fed were to think that labor could continue to deteriorate and inflation would go higher, right? They would have to map out where they see labor at the moment and inflation and which one takes precedent. And quite frankly, unemployment at 4.3% is not, even with the median up to 4.5%, is kind of irrelevant when CPI, medians are rising or are still above target. The Fed doesn't expect to get to the inflation target until like 2028 or something like that. So you you have to really look at this and say, okay, the Fed is isolating labor because they believe labor is like a negative reflex loop where weakness in labor will bring down inflation. So if they save labor and they keep labor steady or at least declining slower, they can fix inflation. But if labor is being thrown around or being distorted by non-recessionary risks, i.e., the economy isn't actually contracting, and you ease into that, you're neutralizing a non-existing risk. So you're not actually neutralizing any risk. You're just becoming more accommodative. And what that'll do is, yeah, it'll help labor likely at some point, but it'll also lift inflation. So that's the risk that I think that the Fed is overlooking because, again, they're very tuned to deflationary economies, given that our economy has not run the way it has been running above capacity for so long in many, many years. Thank you guys so much for listening. If you want free access to our macro base, go to www.market-radar.com or reach out to us on X at the Market Radar.